What's up guys, Mike back here, and today I want to talk to you about real estate investment trusts, otherwise known as REITs. Now, real estate investment trusts are historically one of the best investment vehicles available to investors. And in today's video, I'm going to explain to you why. In fact, the FTSE Equity Index REIT is what most investors use to gauge the US real estate market. And between 2010 and 2020, it had an annual performance of 9.5% return. More recently, guys, the average return for a REIT between November of 17 to November of 2020 was 11.25%, which beats out the S&P 500 and the Russell 2000. Historically, investors looking for this type of yield have done better in real estate than in fixed income. But I don't want to bore you with numbers today, so we're going to talk about what REITs are. I'm going to give you 5 REITs that you can invest in, and I'm going to talk about the advantages and disadvantages of REITs. So let's get into it. And guys, if you haven't clicked the like button or subscribed yet, please go ahead and do so, as it helps my channel get to new faces here on YouTube. So what are REITs? Real estate investment trust means that you're basically investing in a trust that somebody else is managing. Sounds simple, right? Now, when it comes to real estate investing, there are 2 ways that you can go about it. There's active investing and passive investing. Real estate investment trusts definitely fall under the passive category. A quick reference to what the difference is in an active investment, you're swinging the hammer and pounding the nails. In a passive investment, somebody else is swinging the hammer and you're just writing the check. So by definition, the SEC says a real estate investment trust is a company that owns, operates, or finances income-producing real estate. REITs provide an investment opportunity, like a mutual fund, that makes it possible for everyday Americans, not just Wall Street, banks, and hedge funds, to benefit from valuable real estate, present the opportunity to access dividend-based income and total returns, and help communities grow, thrive, and revitalize. REITs allow anyone to invest in portfolios of real estate assets the same way that invest in other industries, through the purchase of individual company stock or through a mutual fund or exchange-traded fund. The stockholders of a REIT earn a share of the income produced without actually having to go out, buy, manage, or finance the property. Approximately 145 million Americans live in households invested in REITs through their 401ks, IRAs, pension plans, and other investment funds. So there you have it, guys. That is the definition of what a REIT is. Now let's get into 5 different types of REIT classes that you can invest in. So the first one is the retail REITs. So when you walk into a shopping mall, more than likely it's owned by a REIT. In fact, 24% of all the REITs in the United States today are retail shopping centers. Retail REITs make money from the rent that they charge their tenants, which are the places you guys shop at. The strongest REITs out there have large anchor stores, such as grocery or home improvement stores. So think of something like a Smith's or a Ralph's or a Publix and Home Depot or something like that. Strong balance sheets and little debt is what you're looking for in a retail REIT. But one cause for concern, with much of the retail shopping being shifted to online only, it has put increased pressure on the REITs that are in this retail space. So that is something to be aware of. Next up is residential REITs. These are REITs that own and operate multifamily housing, such as apartment buildings or mobile home parks. When looking to invest in this type of REIT, one should consider many things before jumping in. For instance, the best apartment markets tend to be where the cost of housing is low compared to other areas of the country. So in places like New York or Los Angeles, where the cost to own a home is very high, that means there's going to be a very strong rental market, because this forces more people to rent, which then drives the demand up, which then allows landlords to drive the prices up, and you get it. Some things to look for residential REITs is a growing economy, such as more jobs available, people moving there, and limited housing. As long as the supply of housing remains low and the demand continues to rise, residential REITs should be a very strong investment to look into. The next up is healthcare REITs. Now, the healthcare REITs will be an interesting subsector to watch, as the average age of Americans get older and older each year, and more of them require nursing homes and more advanced healthcare than what they have. Healthcare REITs invest in things like hospitals, nursing homes, nursing facilities, and long-term care homes. The success of this real estate industry is directly tied to our healthcare system. A majority of the operators in this space rely on occupancy fees, Medicare and Medicaid payment reimbursements, as well as private pay. As long as the funding of healthcare remains a question mark, so does the future of healthcare REITs. I would look for companies whose healthcare experience is strong, with good balance sheets and access to low-cost capital so they can keep buying and developing more properties to house the ever-growing population that needs healthcare services. Number 4 is office REITs. Office REITs are simply office buildings. They receive income from tenants who have usually signed long-term leases. So 4 questions that come to mind for anyone looking to invest in an office space REIT would be these. What is the state of the economy and how high is the unemployment rate? What are vacancy rates like? How is the area in which the REIT invests in doing economically? And how much capital does it have for acquisitions? I would try to find REITs that invest in economic strongholds. Very good metro markets that have job growth, people moving to it, and a lot happening in the economy are good for office REITs. And the last category is mortgage REITs. Approximately 10% of the REITs invested in the United States are in mortgage REITs themselves and not in actual real estate REITs. The best known, but not necessarily the best investments for these mortgage REITs are Fannie Mae and Freddie Mac. In addition, mortgage REITs get a considerable amount of their capital through secured and unsecured debt offerings. Should interest rates rise, then future financing becomes more expensive, which reduces the value of a portfolio of mortgage loan REITs. In a low interest rate environment with the prospect of rising rates, most mortgage REITs end up trading at a discount. The trick here is finding the right one. So guys, let's dive into the last part of this, which is the advantages and disadvantages of REITs. If you haven't already clicked that subscribe button, please go ahead and do it right now. It's totally free. And click that like button if you don't mind, as I will keep providing you with information about how to make money in real estate and personal finance. To sum it up, here's 3 pros and 3 cons. The pros are high yield dividends, portfolio diversification, and highly liquid. Your dividends are taxed as ordinary income. REITs are highly sensitive to interest rates, and there are risks associated with certain types of REITs. So there you have it, guys. If you have any questions, feel free to leave them in the comments below and I will answer every single person. Thank you for watching my video. Please don't forget to click that like and subscribe button as I post here every Sunday. Again, with that, thank you and I'll see you in the next one.